Sunday, the 5th of January 2020. In the last video I put up, probably at the start of December, I think it was, I talked about how I was looking for some feedback about starting a more regular video updates, and that would be through a subscription model. In addition to the free ones that I put up on YouTube, there'd be some private videos. So I got some reasonable feedback from that, and there's enough there, I think, to justify me putting a bit more effort in there. And I've started up a Patreon page. I'll put the link to the page in the comments for this this YouTube video, and I've set it as $8 a month. So it's a work in progress, but I'll guarantee I'll put up weekly content. It's be obviously the same sort of stuff I've been doing for a while. Focus on the gold industry, both the gold price and the gold miners, company announcements, macro markets, and also quite a bit more educational content. I think there's definitely a need to really educate, about how to get better at investing in mining companies. And that's just really sharing some of my experience over the last sort of 5 or 10 years that I've been researching and sort of playing in this industry. So yeah, have a look at the page if you're interested. Try it out for a bit. If it's not for you, you can drop out of it. But yeah, I got some reasonably good feedback. So yeah, have a look, and yeah, I guarantee to put up regular content. So gold price obviously been a tremendous couple of weeks, back up to testing that sort of 5-year high again at 1550. Or what's that, 6 years since, or 7 years now since 2013. So it's a very good move. Excellent chart. Probably a couple of months ago, I talked about how there was kind of probably a bit sort of misguided despair in the industry, in the gold sector, with this pullback, which was quite a shallow pullback, to be honest. And I thought people were sort of dropping interest in the sector pretty quickly. And I talked about this move, the last real bull market from 2009 to late 2011, sort of 2012. We had these big moves up, sort of generally about, I think they're about $250 at a time. And after one of those moves, you have that digestion period for, on average, sort of 3 to 4 months. And that was exactly what we were seeing. And I think it was, to me, this pullback looked even better than some of the ones you saw in the bull market here. That shallow pullback. We didn't get down below 1450. That was probably not even a 30% retracement on the move. It's a perfect little flag there. I always had this 1530 sort of range as the 1525. I said there as the it was the breakdown in 2013. It likely was going to act as resistance, but we've seen this huge upswing in the last couple of weeks now. Once it sort of consolidated that range between sort of 1460 and 1480 for it felt like forever, but I think it was probably five or 6 weeks. And now we've seen it break out solidly there, and it's almost moving too fast. But what we've seen here is that the same thing happened in June, and there were a lot of, I guess, people who had been in the space for a while, like myself, were kind of looking at it and thinking, I might get a bit overboard here. But that trend really went strongly for a few weeks, and it feels like we're going to have the same thing again. And I mean, the trajectory of these moves was all very similar. The steepness of the moves, and this one is the move we saw from June to sort of August. Was identical to these moves we had in the 2009-2011 bull market, those $250 moves for 2 or 3 months and the consolidation. So, in all likelihood, I think we could see the same sort of trajectory again, and that's, that takes us up toward this sort of 1700 area. So that's what the chart's saying at the moment. I mean, it's rare that you see such a perfect technical chart to me like this. This is we've broken out of the sort of head and shoulders bottom, or whatever you want to call that, sort of that was last 4 or 5 years, and the range from that was always the projection was probably going to be around the 1650 to 1700 area. So it's entirely possible we get there in the next few months, I think. But that's just what the chart's saying. Obviously, you've got to keep aware of this. I think there's a case here for a little bit of consolidation, probably at this 1550 area, holding up a bit. Some of the action on Friday with the US assassinating the Iranian general. I think that's sort of now you'll start seeing the headlines that gold's moving on political fears and sort of fears of war. Typically, that's actually not why it's been moving for the past 6 or 8 weeks, but um, that'll be the headline probably. You start to see, and often that happens. The same sort of thing happened in 2017 with some of the North Korea stuff, 2018 I think as well. That that's not generally the underlying. There's always this sort of need for the media to show that gold is trading on fears of war, and that's generally not what's pushing the price. And to my mind, what's really been pushing it is the Fed balance sheet and the easy monetary policy becoming ingrained in the market again. And ultra easy monetary policy. The Fed was able to reduce its balance sheet by about $600 billion in the space of almost 2 years, 18 months, 2 years. And in the last 4 months, I think it's been increasing the balance sheet at 100 billion a month. They're sort of saying that this isn't quantitative easing, but I feel like the market's really not buying it. And it's no coincidence. This is especially the last little bits coincided. I think the S&P 500 has been quite strong, but gold has been able to hold its own very well as well. And that's been telling us something for a while, and it was telling me that this correction was likely just to be a correction, and that there was going to be a renewed upswing. And I think this is becoming. It doesn't seem to be a plan out of this for the Fed. They're just gonna keep printing money here, and it's becoming, even the US dollar is starting to weaken a bit as well. And you seen that in the last few weeks. It's starting to roll over against a lot of the currencies. So I think that's a positive for gold if the US dollar starts weakening. The other thing is, getting back on the gold chart, January tends to be seasonally quite a strong month for the gold price. This is a chart I saw off Twitter from Bloomberg that's showing that gold's 13 of the last 19 Januaries it's up, particularly in the last 4 or 5 years. Actually, you can see there 15, 16, 17, 18, all up. So that's I think that might have been 19 actually. So it's a pretty strong time of the year for gold, and I think we're probably showing the same signs again. So that's all pretty positive action. The S&P 500 is also I mentioned there that gold's been rising at the same time, or gold's been holding its own anyway for the last couple of months, and then rising in the last few weeks, while the S&P's been having this sort of melt up phase that I keep hearing. And it reminds me that the sort of mania, or it's not mania yet, but it's getting pretty near it in some of the in the commentary around the S&P. There's a complete complacency here. I mean, I've been bearish on this for a long time, and I've been wrong the whole time because I guess I've underestimated the support for the market and Trump's ability to keep it going. And you can see here that this is a fear and greed index that CNBC puts out. Generally when you start seeing numbers around this sort of these mid 90s, that's a time it tends to coincide with peaks. And I think the only time I've really seen it as bad as this, or as good as this, is in this period in late 2017, early 2018, where we had like a real melt up phase. Just the market basically going up every day, 0.5%, 1%, almost every day for a month or two. And then it was just, crushed in a period of about 5 days, and when the world was about to end. And I feel like we're in for something similar. I don't know what the catalyst is going to be here. for that, but there's just a massive lack of awareness of potential downside risk here. You know, the Fed can only do so much before it becomes normalized. That expectation of Fed support. Um, and I saw this other chart. There was a quite an important index number came out last night in the US. The ISM Manufacturing Index, which is sort of seen as a gauge of the real economy. This in the past, the S&P 500 and the ISM tended to be, um, you know, the ISM tended to be a bit of a leading indicator to performance of the S&P, but you can see there's been this complete detachment of the index from underlying sort of economic trends that the ISM is really sort of showing. So that's a bit of a warning sign for me. I think that's really just down to if you see some of the moves in some of the US stocks. I saw Apple's above $300 a share, which is, despite the fact that its earnings are actually declining, in gross terms, but not on a per share basis. But that's another discussion. But there's a whole swathe of stocks which have the US market is really earnings are tight. So they're not going up. It's just that there's this wave of money behind the market pushing it higher and expanding multiples. Basically making the market more expensive. So I think there's a definite risk of a considerable fall at some point. But I don't short the market. But that would also be positive for gold, obviously, if that happened. I think one of the other things that's been happening in the in macro markets is that the Australian dollar's had this sort of little bit of a rally as well, while US market and in general there's been a bit of a risk on sort of appetite in the last probably 4 to 6 weeks, probably since the trade war or phase one trade deal was kind of settled. Of course, we haven't really heard any actual real confirmation of that other than sort of rhetoric. So that I think that remains to be seen whether that's actually settled. But that's another thing. But you've seen this sort of little bit of a melt up at the same time. Of you've seen the rally in the Australian dollar up to 70 cents, so up to 70.5 the other day actually. But on that news of the coming out of Iran and sort of that move to a bit of a risk off, we've seen it fall heavily. And I tend to believe, I've spent a lot of thinking about what's the better way to play the gold price, whether that would be in US dollars or in Australian dollars. Australian dollar gold's been a good trade for the last couple of years, while US dollar gold's not performed as well. But in general, I think the Australian economy is ripe for a pretty heavy period and potential recession. I think there's a higher chance of recession in Australia than in the US. So I can't really get away from that belief that the Australian economy has a very soft underbelly, and I think is going to get found out at some point. And that really supports my view of where to put my money in terms of different mining companies. I think the Australian gold mining companies, they've had a bit of a pullback in the last couple of months, but I think on a medium long-term basis, I still think it's the easiest trade is long those good Australian gold mining companies that are sort of world leaders and are well supported by a backdrop, which I think the Reserve Bank will continue to sacrifice the currency, and you'll see the currency go well below this sort of the 66 lows that we saw in 2019, and I think you could be heading into the 50s, that and potentially lower on a long-term basis. If the Australian economy has a real recession, the country's completely unprepared for it, I think. That's been my view for a while. So even though I think that some of those US dollar gold miners have done extremely well, companies like Perseus, for example, those with a strong exposure to the US dollar gold price, but I still expect Australian dollar gold producers to be the better trade over the next sort of say 12 to 24 months. So speaking of the gold miners themselves, I was having a look at the GDX chart, and the GDXJ as well. And we're really up at a crucial level now. The GDX, this 31 kind of level is we're testing the highs in 2016. And it feels good. Like it feels like there's still not a lot of interest in this market, mainstream interest. We've had the consolidation and sort of a healthy pullback over the last 3 or 4 months, and we're ready for another move upwards. What was interesting on Thursday and Friday, actually, the GDX and the GDXJ, for that matter, had this quite significant selling pressure, despite the gold price, being on a very good move, up sort of $30 or $40 in a few days. We've seen the GDX sort of stumble. I'm not sure what's behind that, whether there's some specific factors, if it's low trade over the holiday period, or some of the weightings or some redemptions that are happening. I don't know, but I think that can't sort of if the gold price keeps moving, these indices are going to follow. All the gold miners are going to follow. GDXJ was similar. What I saw on Thursday and Friday actually in Australia was that it was the companies below the GDXJ that were actually doing the best. Companies like West African Resources or Medusa Mining that are in my portfolio, they're not in the GDXJ. They're smaller than that, and those stocks were moving 5% plus on those days. But a lot of the mid caps, the standard mid cap Australian names that are heavy weightings in the GDXJ and the GDX, a lot of them too. They were struggling. So you saw that quite a sort of strange move in the GDXJ there on Friday, struggling to rally. I actually saw the number on the app on my phone, and I couldn't quite believe it. You see the gold price rally sort of $30, and these mid cap miners, smaller mid cap miners, were going backwards in many cases. So I'm not really sure what's going on there. But again, another great looking chart. The GDXJ for me, this pullback looks perfect. Nice. January tends to be a reasonable period. That's these little windows I've put in here. 2016 and 2017 in particular were very strong. I think I've put these are 2 month ranges actually, so January and February in each year for the last 4 years tended to be a pretty good period. 16, 17, and 18 all up. That sort of probably 15 or 10 or 15% in 2019, sorry, and more in both 16 and 17, 18, kind of flat to down. So still think this is seasonally a very good period for the gold market. And again, this looks like a really nice chart here. It's not quite a head and shoulders bottom, but it's had kind of a head bottom here, and a little bit of a shoulder, not quite at the same level as 17 and 18, but it looks like a very good bottoming chart, and that there's room to move on the upside here. And obviously on a long-term chart, we're still, anyone who says that the gold sector is too hot, and people are too interested, and where companies are starting to overpay for assets and all this sort of stuff, we're not even anywhere near a bull market, in like a real bull market in gold stocks, where there's generalist interest for mine. This sector is still completely, most generalist investors are completely unaware of the sector. So if we start to see any money of any significance come into this sector, particularly the juniors, you could see some terrific moves. Even 2016, that was a period where the GDXJ was up sort of 150, 200% in 6 months. I think you could easily see something similar if we see a gold move to 1700, for example. There's going to be a lot of catching up for some of these small stocks to do. So, I've been buying while on this pullback, I've been sort of accumulating positions in my favorites, and starting to look at a little bit down the chain where the real sort of speculative stuff, where I think the interest will probably go. That's usually the way these things move. Interest tends to filter down. I've talked about that a lot in these videos. So I'll put up another video on the Patreon page where I'm going to talk about some of the quarterlies that I'm watching that are upcoming, and my expectations, and some specific companies. Thanks a lot.